Hello to all of our viewers. My name is David McGann. I'm a director here at BMO InvestorLine, and I'm thrilled to be co-hosting today's webinar on trading volatility with advanced strategies. This comes to you as part of our webinar series that seeks to unpack options trading. Be sure to check out our education hub to find other webinars in this series that may be of interest to you. And once again, we'll be joined today with our friends at OptionsPlay, and I'm pleased to introduce Tony Zhang. Tony is Chief Strategist at OptionsPlay, where he leads development of options trading products, education for investors, and oversees the firm's quantitative options research. He's a frequent contributor to CNBC for analysis on the markets with a specific lens using technical analysis, fundamentals, and of course, options. We're pleased to have Tony back. I know we have some great content to review today on trading volatility with advanced strategies. And with that, Tony, I'll hand things over to you.
Yeah, thank you so much, Dave, and thank you so much, everyone, for viewing this. As you said, this is really the culmination of the series of options that we've learned so far with regard to the webinars that we've taught and helping you better understand how you can take some of the strategies that we've learned, some of the fundamental building blocks that we've learned, and start applying them to some advanced strategies such as trading volatility, specifically implied volatility. So we'll take a look at what that means, the strategies themselves, and helping you better understand how to navigate these specific advanced strategies. So let's go ahead and get started. Now, before I do, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we might be using as example purposes during today's session. So what we're going to break down during today's session is first getting a better understanding of what implied volatility even is before we look at kind of how you can potentially trade it. In order to do that, we have to better understand the option Greek. So we'll do a quick review of the option Greek, specifically the important ones for today's discussion for the strategy that we'll be looking at, how the different Greeks will affect the value of your option. And then we'll look at the difference between buying versus selling volatility, what that means in terms of buying volatility, what that means in terms of selling volatility, and what type of market environments might be beneficial for these types of strategies. And we'll talk about different spreads and different straddles that will allow you to take advantage of a specific view that you might have for implied volatility on a stock or an ETF. So let's jump right into it. But the primary thing that I want you to be able to walk away from today's session is a clear understanding as to how can I gain exposure to changes in implied volatility using option strategies, specifically the more advanced option strategies that you can trade for this specific type of outlook that you might have on the overall markets. So let's start off by first understanding implied volatility, because there might be some confusion as to what that means. You know, there's lots of different types of volatility. So what are we referring to when we say implied volatility? In order to better understand that, we have to look at kind of how does an option premium or the price of an option or what consists of the price of a specific option. And when we think about an options price, there's really two primary components that make up the options price. There's the intrinsic value of the option, and there's the extrinsic value of the option. So if we look at the intrinsic value of the option, that is what we consider the option with the in the money value of the option, meaning how much is the option in the money by, and that is simply determined by the difference between the strike price and the current price of the stock. And that's something that you and I don't really have any control over of that intrinsic value. And then there's extrinsic value, which is the time value and implied volatility component of it. These are external factors that affect the value of an options price. So think about how much time is left between now and the expiration of an option that you have control over in terms of which expiration you might want to choose. And then there's implied volatility. That's effectively the market's expectation for future volatility. So if the market expects, for example, if let's say there are earnings or some type of economic event that's coming up that might affect the economics of a specific stock or ETF, that's going to have an effect on the implied volatility of that particular stock or ETF's options price. So for example, if there's an uncertain event coming up, that's going to naturally have a higher implied volatility. And if let's say once that event goes goes by and the information is now known, that implied volatility tends to contract after the event itself. So it's important to understand these different components that make up an options price, and implied volatility is the component that is determined based on how much uncertainty there is between now and the expiration of the option. That will fluctuate as the option price or as the option approaches expiration. Now, the higher the implied volatility of an option, the more expensive the option tends to be. And there are ways that we can measure this. Probably one of the more common ways, or some of the standard ways that we usually think about measuring how the implied volatility of an option, is a metric called IV rank. And that's where we compare the current implied volatility of the option compared to how the range that it's traded within the last 52 weeks or the last year. And IV rank gives us a sense for whether we're at the lower end of that range or the higher end of the range. And it's a very simple metric that ranges from 0 to 100. If you have a stock with an IV rank of 100, that means the current implied volatility of the option is the highest we've seen over the past year. Vice versa, if it has an implied volatility rank of 0, that means it's the lowest we've seen throughout the last year. And if it's a rank of 50, that means we're right dead in the center with regards to the min and the max of the range that we've seen over the past year. So it's a simple metric that gives us just a basic understanding of how expensive or cheap an option is relative to the history over the past year. And like I said, there could be macroeconomic events, and generally speaking, things like corporate earnings or product launches where there's some form of uncertainty as to what the future is going to look like, that will generally change implied volatility. When you have events that are uncertain that are about to come up, you tend to get an expansion in implied volatility. And once that event comes by and the information is now known, we typically get a contraction in implied volatility as the uncertainty factor is removed from the price of the option itself. So that's usually how we think about implied volatility.
Tony, this slide is wonderful, by the way, and I think that explanation was excellent as well. And, what's kind of interesting, at the time you and I are recording this webinar for our audience today, it happens to be November 5th, 2024, which is election day south of the border. So super unique event. And later this week on Thursday, we have the Fed coming out to talk about interest rate policy. So based on what you're describing here, especially the comments around macroeconomic factors can influence implied volatility, is it safe to assume that with an election day today and the Fed, making its announcement on Thursday, that we're probably looking at an expansion of volatility? Could you expand on that a bit?
Yeah, that's absolutely right. And this is probably one of the biggest weeks in terms of uncertainty in the US equity markets that we've seen. Just to give you some context around that, despite the fact that the S&P is within a couple of percentage points of all-time highs, which typically is correlated with lower implied volatility, lower uncertainty, we actually have the VIX, trading near 52-week highs. We have the VIX at 22%. I don't know the last time we saw the S&P make back-to-back all-time highs and the VIX above 20%. You'd have to go pretty far back to find data points like that. So, this is a good example where between the US election and the FOMC meeting coming up this particular week, we see S&P options trade at a very high implied volatility relative to its history, despite the fact that, we're near all-time highs, which typically is correlated with lower implied volatility. So you're absolutely right. This is a big, big week from a macroeconomic perspective, and that's why we have a relatively high elevated implied volatility on, let's say, the overall market, such as the S&P 500 options. So let's further break down kind of implied volatility from a trading perspective. Now that we understand what it is, it's also understand the characteristics of it if we're going to trade implied volatility before we even talk about what it actually means to trade implied volatility. So The thing to keep in mind and understand about implied volatility or volatility in general is that implied volatility is what we call mean reverting. And what that means is that it tends to gravitate around an average over the long run, meaning you tend to have extremes to the high end and extremes to the low end, but overall throughout the entire year, it tends to trade around an average. And what what we see, especially with equities, is that it exhibits some level of seasonality. And this generally seasonality is correlated to the earnings season for most stocks and certain macroeconomic events for perhaps ETFs. Generally speaking, you tend to see an expansion of implied volatility as you approach earnings season, as there's more uncertainty around whether a stock is going to report, strong or weak earnings. And then once the report comes out, we typically see a immediate collapse in that implied volatility because that uncertainty factor is effectively removed once that information is released. So we typically see throughout the year exhibits of seasonality, around that earnings season for stocks and macroeconomic events for ETFs. And what we can do is that the changes in that implied volatility throughout the year can be traded and can be potentially profited if you're using some advanced strategies, such as the ones that we're going to discuss today, to take advantage of these specific changes in implied volatility. So you can effectively take in some of the previous sessions, we've talked about how you can utilize options to take a directional exposure. So if you believe that the stock is going to move higher or move lower, even if it's going to stay neutral, how you can potentially profit from a directional move. But when you're trading options, not only can you profit from a directional move, you can also potentially profit from a change in implied volatility as well. And that's what we're going to explore during today's session.
Tony, another quick question for you here on that slide, just talking about changes in volatility. One terminology or term that I've often heard, and I'm sure some of the folks in our audience have heard, is something along the lines of, volatility crush. Is that an example of volatility basically, coming down after an event like corporate earnings, for example? Is that a term you're familiar with? And can you expand on that? And does that fit into this example here of implied volatility and how it essentially moves?
Yeah, absolutely. And volatility crush is certainly one of the events, I would say, that you would typically associate with trading volatility, because volatility crush is referring to the collapse of implied volatility right after an event comes out where the uncertainty factor of something is removed. So most commonly, it's around earnings. So stocks report earnings 4 times a year. And once that earnings event comes out, we typically see implied volatility will collapse by a certain amount right after the event itself. And that collapse we refer to as volatility crush. So because the volatility or the implied volatility of an option is effectively crushed to a lower level. So yes, absolutely. Implied volatility crush doesn't have to just be on earnings. It could be macroeconomic events as well. But most commonly, it's associated with earnings because that happens most often 4 times a year, where you get that collapse in implied volatility immediately after the event itself, where the uncertainty factor is removed and implied volatility will come in right after the event itself. And that becomes a tradable event because you're effectively taking a view that at a certain point, the implied volatility of an option will come in and lower in value, over a very short period of time.
Great, thank you.
So, in order to better understand our ability using advanced strategies to take a directional view on implied volatility, we have to review 3 important option Greeks. Now, these are Greeks that we have reviewed before, but I think it's important to understand the 3 Greeks that I think are going to be relevant to today's session as we discuss some of these advanced strategies that can allow you to take advantage of a view of implied volatility. And that's going to be Vega, Delta, and Theta. So let's review Vega first. Usually we talk about Delta and Theta when we talk about Greeks, because those are the 2 Greeks that have the largest impact on the value of the option strategy that you trade. But today we're going to start with Vega, because Vega measures the change in the options price for every 1% change in implied volatility. We always state implied volatility in percentage terms. So when we talk about Vega, we're talking about how much does the value of an option expect, or how much do we expect the value of an option to change if the implied volatility of the option either increases by 1% or decreases by 1%. And whenever we're talking about option strategies to take advantage of implied volatility, what we generally want to have is maximum Vega exposure, meaning an option that we're trading that will be relatively sensitive to changes in implied volatility. And what we're trying to do is effectively maximize Vega so that we can maximize our exposure to those changes in implied volatility. So if, for example, if we're taking a view that implied volatility is going to come in or collapse, we want some type of option strategy that gives us exposure to a collapse in implied volatility. We're going to use Vega to help us measure how much exposure do we actually have when we're looking at an option strategy. We're going to look at different option strategies and help you better understand just how much Vega exposure you generally will have with each one of those strategies. Now, however, you can't just take an option strategy and have Vega exposure by itself. Every option strategy will have exposure to other things as well, changes the underlying price, changes with time. So when we think about getting exposure to implied volatility, generally speaking, what we're trying to do is we're trying to maximize our exposure to Vega, but at the same time trying to, in some degree, minimize our exposure to delta and potentially have theta work in our favor. So just as a recap, delta measures the change in the options price for every $1 of change in the underlying price. So for example, if we have a stock with, an option with the delta of 0.5, that means if the stock moves by $1, the option price will move by half as much, or by 50 cents. So again, whenever we're trading implied volatility, we generally want to minimize that delta component of an option that we're trading, because that is going to affect the value of an option based on the changes of the underlying price, which we may have a view in the underlying price as well. But generally speaking, we want to minimize that, because changes in Vega, where implied volatility is working in our favor, could be effectively offset by changes in the underlying price itself. So we're trying to minimize delta to some degree when we're trading these types of strategies. And lastly, theta. Theta measures the changes in the options price for every 1 day passes by in time. And time, as far as I know, continues to march on regardless of what our views are on a specific stock's implied volatility or directional view. So generally speaking, whenever we're taking a view on implied volatility, we generally prefer option strategies where time value is working in our favor. So for every day we're holding on to the trade, time value is eroding and we're capturing some kind of time decay, because that means that as implied volatility potentially works in our favor, we also have the theta component working in our favor, not against us. So those are some of the Greeks that are going to be very important to understand and have exposure to, that you're going to have exposure to, that you're going to want to figure out what the different variations are going to be with different strategies. And we're going to review that with each of the advanced strategies that we're going to look at during today's session. So let's talk a little bit about the two different views that you might have with implied volatility. And the first one we're going to look at is selling volatility. And this is referring to that volatility crush that David was referring to during in the previous question, which is, what do you do if you expect that implied volatility that's high today is going to be at a lower value sometime in the future? So for example, if let's say a stock currently has an implied volatility of 40%, and you believe that sometime in the future that implied volatility is perhaps going to be half as much as 20%, how do you actually take advantage of that? And this is really where we're going to be looking at taking any type of option strategy that's going to give us negative Vega exposure. And what negative Vega exposure means is that it's an option contract that's going to generate profits if the implied volatility option is going to decrease in value. And generally speaking, any type of option strategy where you're selling an option, so if you're selling a call or selling a put option, or where the net strategy driver of an option is a short option, that's where you're going to have negative vega exposure. And that's going to benefit if the implied volatility of an option goes from a higher level down to a lower level. So when we refer to selling volatility, we're referring to taking a position with an option contract that's going to benefit from the contraction of implied volatility from a higher level to a lower level. And generally speaking, like I said, that will happen typically after some type of economic event or some type of earnings announcement comes by and the uncertainty factor is removed, and implied volatility will typically contract after that event itself. And then conversely, on the flip side, you could have a view that implied volatility is going to expand in the future. Now, we typically see implied volatility expand going into some type of economic event, such as the U.S. election or the FOMC meeting. We tend to see implied volatility will slowly increase in value as we approach that event itself. And once the event happens, that's when we tend to see that volatility crush. So, for example, if let's say you expect that implied volatility is going to expand going into an event, that's where you want to take an option position where you have positive vega exposure. That's where you're going to be buying options that will generate profits if the implied volatility expands from the time that you buy it to the time that you sell that option. And generally speaking, whenever you're buying an option or where the strategy driver of a complex strategy is a long options, that's when you're going to have a position where you're going to have positive vega exposure that's going to benefit from an expansion in implied volatility. So let's start reviewing some of the strategies, some of the advanced strategies, and just giving you a better understanding of each one of these strategies and what type of exposure you're going to have to that implied volatility. And then at the same time, understand what exposures that you're going to have, the other components that's going to affect the value of your option. We're going to look at the different degrees of exposure that you have to vega, delta, and theta, and what that means for each of these specific scenarios. So the first one we're going to take a look at is a bull call spread. And we've used this strategy before in one of our previous sessions on debit spreads. So what we're going to do is we're going to look at a bullish debit spread here and what that means with regards to your exposure to implied volatility and also your exposure to the other components. So in this example here, we're going to look at buying a 225, 230 call spread, a debit spread on Apple. So we're buying the 225 calls for, in this particular case, $7 and selling the 230 calls against that for $3.50. Net, what you're paying is $3.50 for that spread. And that's why we call it a debit spread, because you're paying premium to enter this particular contract. Now, typically, as we've discussed in previous sessions on debit spreads, you enter a debit spread when you expect the stock to rally. Typically, you expect it to rally fairly substantially to justify buying that debit spread. But, what we didn't discuss in previous sessions is the fact that because the primary strategy driver of this strategy is a long option, is that long 225 call option, because you're a long an option, you are going to have positive vega exposure. So this is going to be a strategy that benefits if the implied volatility option expands in value. So again, going into an economic event or going into a earnings event, this is where we typically see that expansion in implied volatility. This is a strategy that will benefit from that expansion in implied volatility. Now, we generally consider debit spreads as a strategy that gives you a medium amount of vega exposure. It doesn't give you a lot of vega exposure. That's certainly not a strategy that gives you a little amount of vega exposure. So a fairly medium positive vega exposure that benefits from an expansion in implied volatility. But it also gives you delta and theta exposure. And in both cases, I would say it gives you a medium amount of delta and vega exposure. In this particular case, because you're paying, you're buying a bullish debit spread, it's going to give you medium positive delta exposure, meaning this is a strategy that's going to be profitable if the value of the underlying increases in value, versus decreasing in value would actually reduce the value of this debit spread. But lastly, I think one of the things that you have to remember with a debit spread is that the primary strategy driver is a long option. And whenever you're long an option, you have negative theta exposure. And what that means is that as time passes by, that's going to decrease the value of your option. Now, you're going to offset that to some degree because you're also short that 230 call option, but you're going to have negative theta exposure, meaning time value is working against you. So as you are holding onto this option, you are hoping that the stock is going to rally in price, and you're also hoping that implied volatility is going to expand. But at the same time, as you hold on to that, time value is going to erode the value of that option each day you hold on to it. So that's something to consider when you're thinking about buying a debit spread, is that you're going to get that positive Vega exposure, which is one of the few strategies that you can use if you expect an expansion in implied volatility, but you have time value working against you, which is one thing that you have to factor into when you're thinking about these types of strategies, because you don't want to hold on to this trade for too long. The longer you hold on to it, the more that time value is going to erode any potential benefits that the increase in the stock's value is going to have and an increase in expansion and implied volatility is going to have for this specific strategy.
Tony, I think this is a great example, and absolutely. I mean, we had a separate webinar where we went pretty deep on debit spreads, right? But as you mentioned, we didn't necessarily get into the nuances of Vega, delta, theta, in particular, implied volatility. I think for options traders that have tried strategies like this, and perhaps around an event like earnings, like you mentioned, Tony, right, have on some occasions at least been surprised where the price of the underlying has moved in the direction. So let's say it's a bullish debit spread, has moved in the direction that they're expecting, but the option prices just really didn't move a great deal. And is that really a function then of that volatility crush, where the weight of the Vega coming down offset, the benefit or the lift in delta? Is that really what's manifesting in that kind of a scenario?
Yeah, that's exactly right. And I think most options traders have experienced this, where they bought an option, maybe a call or a put. They saw that the stock moved in the direction that they expected to, yet at the end of the trade, they either didn't turn a profit or potentially even lost some money on that specific trade. And they're kind of scratching their heads as to what happened. And generally speaking, those are the two components that worked against them. It's usually Vega and theta that worked against them. So, you might have that delta component working in your favor, but you had that perhaps a bit of a collapse in implied volatility, which decreased the value of the option. And then you have a little bit of time that it went by that decreased the value of the option. And the combination of that Vega and theta exposure effectively offset any gains that you might potentially have from delta. So, that's probably the most common case that I think a lot of beginners have when they just first buy their first call or put, and then maybe don't really understand why they lost money on the trade, even though the underlying moved in the direction they expected to. But usually that comes down to both theta and Vega working against you in that particular example.
And so maybe a quick follow on then, Tony, like, is there a bit of a buyers beware message here where, despite having a confident directional bias, for example, using the same example, bullish bias, if Vega is kind of, on the higher end, to kind of tread cautiously, especially knowing that maybe it's because there's an imminent event and that they should expect, a drop off? Is there a bit of a buyer's beware kind of message there when thinking about getting into a strategy like this, if Vega is already at an elevated level?
Yeah, so what we think about is we look at that IV rank metric that we looked at earlier today, which is a measurement of exactly where implied volatility is today relative to its 1-year history. And whenever you have an IV rank on the higher end, meaning above 50%, statistically speaking, you have a higher probability of that of implied volatility coming in, because, like I said, implied volatility is mean reverting, right? It tends to revert to its mean. So if it's above its average, it tends to revert back to its mean. So that's one thing that you want to keep in mind that when implied volatility is relatively high, it does not particularly suit buyers of an option from a statistical perspective. So that is something that I think is that traders should have that knowledge of and understanding of, taking a look at implied volatility relative to its own history to better understand, is this kind of the right environment to be buyers of options? And only doing so in the cases where where perhaps implied volatility is low, or you have such a strong confidence in the directional move where you are confident that even when you get some type of volatility crush, you'll overcome that because you're expecting such a large move in the underlying stock itself that delta will offset any losses that you might have from Vega or Theta.
That's great. Thank you, Tony.
Yeah, absolutely. Great questions. So next, let's take a look at a second strategy that we've also looked at, which is a credit spread. So it's very similar to a debit spread, but here what we're doing is we're taking a bullish stance, more of a neutral to bullish stance using a credit spread. And this is really where we're selling the 225 put on Apple. And then instead of just outright selling the 225 put, which carries a substantial amount of risk and margin requirement, what we're going to do is we're going to buy a 220 put against that. And it gives us a payoff graph that's very similar to the debit spread, but it's doing so in a way where we're, the strategy driver of the option is that short 225 put, and that's going to give us a short option strategy, which gives us negative Vega exposure. So if we sold that 220 put for $8, bought the 220 put for $4, net here, we're collecting $4 on this credit spread. That's the type of strategy that's going to give us negative Vega exposure. So with this credit spread, we are similar to the debit spread, expecting the stock to rally or stay neutral, but what we're looking for is implied volatility to contract. So if you look at the exposure that we have for Vega, Theta, and Delta, very similar to debit spreads, we generally have a medium amount of impact for each one of these strategies, but they are very different in terms of the direction of exposure that we have. So in this example with the credit spread, we have a negative Vega exposure. So what that means is that this is the type of strategy that's going to take advantage of a collapse in implied volatility. Unlike a debit spread that takes advantage of an expansion in implied volatility, a credit spread takes advantage of a collapse in that implied volatility. But just like the debit spread, this has positive delta exposure, meaning we're taking a bull put spread. That's going to benefit if the value of the underlying increases in value. So delta, we're going to have the same amount of exposure, the same directional exposure as the debit spread. But the difference here is that theta in this particular case actually works in our favor. We have a medium amount of theta exposure, but a positive theta exposure. And what that means is that as time passes by, this strategy is going to work in our favor if all other factors are kept equal. So even if implied volatility doesn't move and the stock doesn't move from a directional perspective, time value is going to keep working in our favor with a credit spread. So what that means is that you can take advantage of a directional a directional view in implied volatility, meaning you believe that implied volatility is going to collapse. But even if that doesn't necessarily work in your favor, you still have time value working in your favor, unlike the debit spread, where if the implied volatility and the delta is not working in your favor, you still have time decay working against you as you're holding on to the value of that option. Here, time is working in your favor, which is why in this particular case, even though you have the, if you have a view that implied volatility is going to come in, a credit spread like this will, also work in your favor just from time passing by as well. So this is one that I think is quite popular for a lot of traders, is using a credit spread to take advantage of a collapse in implied volatility. The next one we want to take a look at here is a short straddle. And this is where we are, and this is the type of strategy that we typically consider as sort of the most pure way that you can take advantage of a directional view of implied volatility. So here what we're looking at is selling a 225 call option for, let's say, $5, and at the same time selling the same strike price, the 225 put option, and collecting $5 for a net credit of $10. And as you can see, this is a strategy that is unlike most other strategies. This is a strategy that will profit if the stock price effectively does not move. If the stock price moves, you start to see losses on one side or the other with regards to selling either the call side or the put side if the stock were to increase or decrease in value. So you typically will only short sell a straddle if you believe that the stock is going to stay neutral and you expect implied volatility to contract. So this is a strategy that's going to give you a very high negative exposure to Vega because you are short two options. Now, you're not, in the previous examples of the debit spread and the credit spread, you are either long an option and short an option, or short an option and then long an option. So you're always offsetting that Vega exposure that you have to some degree. In this particular example, you're short both a call and a put. And what that means is that you have Vega exposure on both the call or put, negative Vega exposure on both the call or put, which gives you a very high amount of negative exposure to Vega. So this is the type of strategy that's going to benefit greatly from a collapse or contraction in implied volatility. The other benefit that this strategy has is that it has what we consider minimum delta exposure, at least initially. Meaning, if the underlying stock doesn't move, you have very little delta exposure because whatever delta exposure you have from the call side is effectively offset from the delta exposure that you have from the put side. They effectively offset each other so that initially when you enter the trade, your delta exposure is very close to zero, if not zero. So what that means is you have a very pure exposure to Vega without much exposure to the underlying or the changes in the underlying. However, that does change if the stock were to move substantially because one side will start gaining deltas and the other side will start losing deltas. And, due to gamma, which something we haven't referred to during today's session, will start to change the delta exposure that you have on the net strategy itself. But initially, when you get into the trade, the delta exposure is minimal or close to zero. And lastly, the theta exposure, because you are short two options, time decay is working in your favor on both sides of the option. So this is a strategy that really you want to take if you have a view that implied volatility is going to collapse, and you expect that collapse to happen over perhaps a short period of time, and you're not expecting there to be a much change in terms of direction, and you expect that time value is going to work in your favor as you hold on to the specific trade. So this is a trade that does have unlimited risk as well. So this is certainly, swimming in the deeper end of the pool with regard to the option strategies or the complex option strategies. But for those traders that are looking for that pure directional exposure to implied volatility, short straddle is about as pure as you can get to the changes in implied volatility with somewhat minimal impact from delta, at least initially, and you have time decay working very much in your favor as long as you hold on to this short straddle. But like I said, because it has unlimited risk, especially to the upside, and substantial risk to the downside, you are, generally speaking, swimming in the deep end of the pool with this strategy. And then lastly, what I want to take a look at is sort of a combination of the different strategies we've looked at here, which is a ratio call spread. Now, this is a neutral to bullish strategy that you might take, and this strategy is constructed similar to a debit spread. However, what you're doing is instead of just buying the 225 call option and paying $5 and selling one the 230 call option for, let's say, for $3, what you're doing is you're selling two contracts of that 230 call. And in this particular case, instead of just collecting $3 by selling one contract of the 230 call, if you sold two contracts of the 230 call, you're going to collect a total of $6, which brings this trade to a net credit as opposed to a net debit we've seen in the debit spread example that we used at first. And what that generally means is that you're going to have a negative Vega exposure as opposed to the positive Vega exposure that you had with the debit spread. So this gives you a strategy that gives you directional exposure to the upside. So if you expect the stock to rally modestly, right? And and we'll talk about that here in 1 second. Where if you expect you expect the stock to rally modestly, and you expect a contraction in implied volatility, this is a strategy that will allow you to get that medium and vega exposure, because you're short 2 call options. The strategy driver of this particular trade is that short option. So short options will benefit from a contraction in implied volatility. So this is a strategy that's going to give you relatively medium vega exposure. So exposure if the implied volatility were to contract, and at the same time it gives you a relatively small delta exposure as well. Because you're long that 225 call and you're short 2 call options of that 230, the 2 deltas tend to negate each other for the most part, but you're going to still maintain a small delta exposure, small positive delta exposure, so it benefits as the stock rallies in value. But because you have 2 short options, that's going to change if the value were to, if the underlying were to rally substantially. As you can see from the P&L graph of this chart, this is a strategy that benefits if the stock rallies modestly, but delta will start working against you if the stock rallies substantially. Similar to the short straddle, this is a strategy that technically has unlimited risk to the upside. So if the stock were to take off substantially to the upside, you have more and more risk with this specific strategies. So even though it gives you small delta exposure initially, if the stock were to rally substantially, that delta exposure will change and will turn actually into negative delta exposure. And then lastly, theta. Unlike the debit spread where theta is working against you, this is where theta is going to work in your favor, because you are short 2 contracts versus being long only 1. So with the debit spread, where you are taking a directional view in implied volatility and delta, but theta is working against you, this is an example where you can kind of take that neutral to bullish view, but actually have a small theta exposure. So in these different variations that we've discussed, today's session, debit spreads, credit spreads, straddles, and now ratio spreads, this is all giving you a different combination of exposure to that vega, which is changes in implied volatility, with varying degrees of exposure to delta and theta. So it's all about how can you get exposure to changes in implied volatility, while to some degree either minimizing or maximizing exposure to other components, either a directional view or to changes in time. So I think the best thing to do here is now to take just a review of what we've learned and take a look at kind of all 4 strategies in kind of together, and get a better understanding of kind of the different exposures that you get to vega, delta, and theta. So let's look at those 4 strategies, right? So in 3 out of the 4 strategies, you have what we call negative vega exposure. So credit spreads, straddles, and ratio spreads, you're going to get negative vega exposure. So that's a strategy that's going to take advantage of a collapse or contraction in implied volatility. And I would say that, as a general rule of thumb, you generally have more opportunities to take a view that implied volatility is going to come in or contract because of that volatility crush. It is more common to have a view of implied volatility decreasing because that volatility crush happens over a very short period of time, versus the expansion in implied volatility tends to happen over a longer period of time. So as you approach the US election, as you approach an earnings season coming up, that expansion in implied volatility happens slowly over a period of time, versus the collapse in implied volatility happens over effectively instantaneously. So that's why I generally tend to find that there are more traders that are trading that collapse in implied volatility rather than expansion. But, for those that are trading that expansion, debit spreads are one of the few strategies that give you the ability to trade that expansion in implied volatility. With all of these strategies, with the vega exposure that you get, what you're trying to do in some degree is to minimize that delta exposure, because delta exposure is going to potentially offset any gains that you might potentially get from that Vega exposure. So you have a directional view on that changes in implied volatility, and what you want is exposure to that change in implied volatility without other factors such as delta, meaning the changes in the underlying price itself having an outsized influence on the value of the option itself, because that could potentially wipe out any gains that you might have in that change in implied volatility. So with delta, with debit and credit spreads, you have what we consider a medium amount of delta exposure. So a fair amount of delta exposure that could potentially offset any gains that you have in Vega. And the difference between debit and credit spreads, I think, it's coming down to theta, right? In debit spreads, theta is working against you. So, you could potentially have delta work in your favor or against you, but time decay, meaning time is always going to work against you when you're using a debit spread. So that's one component that's really important to understand, that if you are taking a view in an expansion in applied volatility using a debit spread, you have to be really careful about that time value. You want to minimize the amount of time you're holding on to that debit spread, because time value is always working against you. On the flip side, with the credit spread, because you have positive theta, a medium theta exposure, that's time decay is working in your favor. So even if, let's say, implied volatility may not be moving as much in your favor, or delta might not be moving as much in your favor as you would like, time value is always going to work in your favor in that particular example. Or if both the implied volatility and delta is working in your favor as you're expecting, time value is just going to even further increase your potential profits on that trade, because time value is working in your favor. And then when you look at short straddles and ratio spreads, that's really where you are getting a fair amount of short Vega exposure, meaning exposure where the collapse or the collapse in implied volatility is working in your favor. But the difference between short straddles and ratio spreads is that short straddles are going to give you, at least initially, very little delta exposure, which is generally what you want, right? You want maximum exposure to Vega with minimal exposure to delta, and time value works in overtime in your favor because you're short two options. So that is kind of, at least initially when you enter a short straddle, kind of the best case scenario of how you can get maximum Vega exposure with minimal delta exposure and maximum theta exposure. But keep in mind that strategy does have unlimited risk, and that delta component can increase in terms of exposure if the stock were to drift either substantially higher or substantially lower. And lastly, the ratio spread kind of gives you a bit of a combination of the different strategies, right? You have medium Vega, short Vega exposure similar to a credit spread. You have a slower amount of delta exposure. So unlike the credit spread, where delta is going to be less of a component for changes in the underlying, and you have time value working in your favor, but perhaps not as much as you do in that credit spread. So ratio spreads are kind of a bit of a combination of the different ones that you have. But as you can see here, what you get is 4 different strategies with 4 different amounts of Vega exposure. None of them are perfect, but you get different amounts of Vega exposure with different amounts of delta and theta exposure. And it's just a matter of figuring out which one works best for you and your specific outlook that you might have on a stock based on your expectations for implied volatility and also your expectations for the underlying security itself in terms of delta exposure. So with that, that covers what I wanted to share with you today during today's session with regards to how you can potentially trade changes in implied volatility, what that means, and the different option strategies that can allow you to do that.
Thank you very much, Tony. As always, wonderful job again, taking a little bit more of a complex topic. In this case, we're talking about implied volatility and the impact that can have on options and introducing advanced strategies. I think you've done a wonderful job both with your verbal overlay and with really simple and easy to follow slides. So excellent job once again. Reflecting back, I think this is our 9th episode in this series. And so for our audience, if this is the first one you're tuning into, obviously you chose a wonderful one, but please go back to our education hub. We've got 9 videos in total, 9 webinars in total with our partners at OptionsPlay, the majority of which with Tony here. And that's where you'll find everything from an introduction into options, an introduction into single leg options trading. And then we transition into things like income generating strategies like covered calls. We had an excellent one on covered calls, Tony. We then transition into multi-leg options and talk about debit spreads and credit spreads. We have a great webinar also on the Greeks. And so Tony obviously spent a great deal of time today talking about Vega in particular because of obviously, how closely intertwined it is with implied volatility. But we go deep into all of the various Greeks in a webinar as well. So thank you, Tony, and to the OptionsPlay team for just a wonderful job helping our investors, our clients, our audience get a lot of great education and insights into the world of options trading. It's been a wonderful journey. And again, thank you for today's session as well. And thank you to our audience.